90% loan application by individuals, normally called salary loans, will be approved by banks as the demand for bank loans starts to awaken at 7.8% growth in April 2018, according to the Bank of Uganda, which is still far away from the growth in the excess of 20% when the economy was at its best. We have a story to introduce the link. Statistics from Bank of Uganda show that banks really love salary loan or personal loan borrowers, as these enjoyed a 90% approval, followed by manufacturing at 62%, agriculture at 59%, trade at 54%, and real estate at 48%. Overall, private sector credit grew by 7.8% in April, from 3.8% a year earlier. Some of the key drivers for demand is trade, but it still lags behind in terms of attracting credit, with only half of the loans approved. The other factor to consider is the new financial sector regulation called IFRS 9. These require financial institutions to anticipate bad loans and therefore provide for them in their books of accounts. This means that banks are more nervous and will now not easily lend, and even if one has collateral like land, that may not suffice. Those facts are the basis for our discussion of business on the link, coming up shortly. Welcome again to the second edition of the link, and here we discuss business. We link you to opportunities. We also discuss issues that will help you make business decisions. Tonight in the studio we have two important guests. We have John Warugembe. He is the ED of the Association of Small and Medium Enterprises. Welcome, John.
Thank you very much, Sam, for having me here.
And we have Miss Grace Makoko, who is a career banker. Economy that could make it a little harder if I want to borrow money to do business.
I think when you look at the business environment, purchasing power of the people, the cost, which really the cost of goods and the people's ability to purchase, I think that is a major concern. You find that speaking to traders, the slow movement of inventory in the seasons that used to be high selling seasons, you don't see as much demand from their clients or their customers. So I think that is a reality. Going downtown and going and speaking to the traders, particularly and the wananchi, you find that where you'd have booms at Christmas or festive season, Easter, in this the different months where people are expected to purchase a lot or to have a lot of business activity, you're seeing a slowdown. I don't know if you've had a chance to visit the malls. All these malls, a lot of them are empty. A lot of them, people are opening business for 3 months, 6 months. If you go back 6 months later, you find a different set of shops because the other ones didn't break even, couldn't pay the rent and left. So all those are realities that are affecting business people's ability to make money and therefore pay off credit if they're to qualify for credit, ability to pay off credit. So those are the realities. There is also the issue of banks' risk appetite. You touched on IFRS 9 in your introduction. IFRS 9 brought in, it's really meant, it's a good regulation that is supposed to drive behavior. It's supposed to drive behavior to make lenders think through the loans they give. What happens is that banks take deposits from you and me, from everyday people, and then lend that money. So what IFRS 9 is really the ethos of it, the heart of it is saying, before you give out this money recklessly, think about who you're giving to. So put capital aside for expected credit losses. In the past, banks were expected to make provisions if a loan is going bad. Now they are saying, after following the financial crisis, they're saying, hang on, you lenders were gung-ho, you are reckless, you are lending even people who you had no business lending. But you're lending customers deposits. And in the end, when you go bust, it's the taxpayer who picks the bill. And the depositors lose their money. For Uganda, you only get up to 3 million of the money from the deposit insurance fund. So they're saying, banks, put aside capital, have more skin in the game. Get your own capital, your retained earnings, and put aside as expected loss in the event that your loans that you've given go bad. Now this then drives the correct behavior where banks decide to price for risk. Banks do a better credit appraisal before they give anyone money.
So in effect, Grace, it means that I said banks are going to be more careful.
Correct.
John, what are the SMEs saying? Do they want to borrow, or are we assuming here?
No, I think she's mentioned very correctly that the banks are holding depositors' money, and therefore they need to be very careful whom they lend to. At the same time, from our perspective, we get the impression that this regulation, IFRS 9, is going to negatively affect particularly small businesses, because all of a sudden the banks are going to start looking at SMEs with a riskier, with a kind of risk lens, saying, you know, these are risky clients and so on. If I'm to give a long-term loan of 10 years, it means I have to provision more. It means I have to keep more money aside to expect. And of course, if you're talking about an expectation, it means that you're going to look at people who are more likely to default. And who are those? Those will be small and medium enterprise owners.
So we need small enterprises to thrive. According to numbers, actually, people who are getting this money are personal loans. Unless now I'm going to say, get a personal loan, but I need to have a job with a salary and put it in a business, which can also be tricky. So Grace, if I dare against all odds as a small business, what should I do to make sure the banks give me money anyway?
Okay. Think about it as five C's, the 5 C's of lending. So one is capital, how much capital you have, how much capital you have as a business person in the business. So the banks look at that. How much skin do you have in the game? Then they look at things like the business plan, your capability to pay. When they look at your business, is it viable? Can it meet its running costs and also meet debt servicing costs? So the capability. Then the other thing they look at is the character of the person. Character, you know, you can have ability to pay, but there's also willingness to pay. So some people are, you know, dodgy, or they don't have a good, they haven't had a good track record, which dovetails into the 4th C, which is credit history. How have you been paying? How have you been banking? A lot of the people are turned away because they don't have a banking relationship with the lender, or they don't have anything, statements, they haven't formalized, they're not running their business in a formal way. So credit history and character sort of going to share. Then lastly is collateral. And collateral should be the last. No one as a business person should give you a loan based on the collateral you have. It should be one that you have enough capital, 2 that it's a viable business and it can pay for itself, 3 that you have the character, the discipline, that you have integrity, your values. Then for your credit history, when you go to the Credit Reference Bureau, how you've been paying loans, if you've been paying, your credit history, then collateral should be that last resort. You shouldn't have a lender lending you against security, because that is just setting you up for failure. You've got to have character as a business person. Let's take our last question, being told time is out. John, Grace has said important things, like the character, like your books, I think. So what are you doing? Your people don't have books. How are they going to get money?
No, I think the infrastructure to determine some of these things is not necessary. So if you look at the Credit Reference Bureau in particular, it's only looking at people who are banked, but there are many other parameters that you could look at. So because the infrastructure is limited at the moment, how do you judge character? How do you track the character of an individual? You're only going to look at a bank statement, but is that representative enough? Can we rely can we use technology and big data and so on to make it easier for small businesses who may not necessarily
John, so are we stuck?
No, we are not stuck, but the world is moving, and it means that it's easier now, for instance, to get a credit score and a character reference online, and banks should explore these options. They shouldn't use the old and tested methods of looking at bank statements. They should be open-minded to say, okay, is there other ways of determining someone's ability and willingness to pay apart from simply looking at their banking history or asking for a business plan, or asking for a cash flow statement? How else can we help small business people and handhold them to ensure that they access finance to actually grow?
I read something like affirmative action before we get to use the big technology. Thank you very much, John and Grace.
Thank you.
We didn't have enough time to thrash this issue because of the time constraints with other issues here, but we promise in future to come back so that the viewers can get more of a piece of this, so they can take away something from it. Thank you very much for joining us. And viewers, that is the link.
Parents,